Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 2 of understanding solvency ratios, a key to financial health. Assessing financial health. Think of solvency ratios as a fitness tracker but for businesses. Just like how a tracker monitors your health stats to ensure you're in good shape, solvency ratios keep tabs on a company's financial well-being. They measure the ability of a company to meet its long-term debts and obligations. When businesses have high solvency, it means they have enough assets to cover their liabilities and more. It's a sign of stability that suggests the company can weather financial storms and keep growing. On the flip side, low solvency can be a red flag, hinting that the company might struggle during tough times. Risk evaluation. Imagine walking a tightrope without a safety net. That's what investing or lending to a company with poor solvency ratios can feel like. Solvency ratios help you gauge the risk involved by showing you how much debt a company has relative to its equity. They act as your budgeting buddy who helps you see whether a company can handle its debt load without faltering. For investors and creditors, these ratios are like a risk assessment tool. They help you decide whether it's safe to invest your money or if you'd be better off looking elsewhere. A good solvency ratio often translates to a safer investment, reducing the likelihood of financial loss. Regulatory compliance. Solvency ratios aren't just for internal number crunching, they play a vital role in keeping a company above board with laws and regulations. Companies often face regulations that require them to maintain certain financial standards. Solvency ratios act like a report card, providing clear metrics to regulators, ensuring businesses operate within legal boundaries. Moreover, maintaining good solvency ratios boosts investor confidence. When investors see that a company adheres to regulations and maintains strong ratios, it reassures them that their investment is in safe hands. It's not just about crunching numbers, it's about building trust and keeping the doors open for future investment opportunities. By keeping an eye on these ratios, companies can avoid regulatory pitfalls and convince both investors and regulators of their financial soundness. Interpreting solvency ratios. Understanding solvency ratios is crucial for anyone interested in gauging a company's long-term financial health. These ratios help determine whether a company can meet its long-term liabilities. But how do you make sense of these numbers in a meaningful way? Let's break it down in 2 important ways: comparing to industry standards and analyzing historical trends. Industry comparisons. Have you ever wondered how your favorite sports team is doing compared to others in the league? Solvency ratios work in much the same way for businesses. By comparing a company's solvency ratios to industry averages, you can see how well it stacks up against its peers. Why it matters. A company might appear financially stable at first glance, but if its ratios are below the industry average, it could be underperforming. Avoiding misleading data. Without industry comparisons, a decent ratio might give a false sense of security, especially if the industry standard is significantly higher. To put it simply, if a company were an athlete, industry averages would be the benchmark times. Falling short of these times can signal trouble, while meeting or exceeding them might indicate a strong position. Historical trends. Imagine watching a movie where each scene is more intense than the last. Solvency ratios tell a similar story when you look at them over time. By analyzing the trends, you get a clearer picture of a company's financial stability. Spotting patterns. Is the company improving, staying the same, or getting worse? Trends can reveal crucial insights that a single snapshot can't show. Predicting the future. Consistent improvement might hint at future growth, while deterioration over time could be a red flag. Think about climbing a mountain. If you're steadily going up, it indicates progress. If you keep slipping back, it might be time to reassess your path. Historical trends in solvency ratios work the same way. Interpreting solvency ratios isn't just about the numbers themselves, but about understanding the story they tell. By placing these ratios in the context of industry benchmarks and historical changes, you gain a much deeper insight into a company's financial health. Want to make informed decisions? Dive into the details and watch how the numbers play out over time. Limitations of solvency ratios. When it comes to assessing a company's financial health, solvency ratios are often used as a fundamental metric. They help determine whether a company can meet its long-term obligations. However, these ratios come with some important limitations that are crucial to understand. They don't always tell the full story, and here's why they're not foolproof. Static analysis. Think of solvency ratios like a snapshot. They capture one moment in time, providing a picture of a company's financial condition at that particular point. But is that enough? While these ratios help gauge the current state, they don't predict the future. The financial world is not static, it's ever-changing. So, relying solely on these figures is like using yesterday's weather report to plan for today's activities. Financial markets, like the weather, can change quickly, and solvency ratios might not signal shifts such as sudden revenue loss or unexpected expenses that could affect a company's ability to pay its debts down the road. They might miss the nuance of changing market conditions or company-specific events that could alter future outcomes. Non-financial factors. Imagine assessing someone's health purely based on their weight. You'd miss out on vital details. Similarly, evaluating a company's solvency cannot be solely based on numbers. There are non-financial factors at play too. Consider the company's management team, market positioning, or its reputation. These are intangible assets that numbers alone can't capture but can significantly impact financial health. For example, leadership quality. A strong management team can navigate financial challenges better, steering the company in a positive direction. Market trends. Industry shifts or consumer behavior changes can impact long-term sustainability, beyond what ratios reveal. Regulatory environment. Changes in laws or policies can also alter a company's financial landscape significantly. Ignoring these aspects can lead to an incomplete analysis. Solvency ratios are just one piece of the puzzle, and without considering the entire picture, important details can slip through the cracks. In summary, while solvency ratios are essential, they are not the whole story. They need to be viewed as part of a broader financial analysis strategy, much like reading a headline without the context of the full article would give you a partial view of the news. Solvency ratios stand as crucial indicators of a company's financial health. They reveal a business's ability to meet long-term obligations and offer insights that are vital for any serious financial analysis. Ignoring these ratios can leave investors and managers blind to potential risks. Incorporate solvency ratios into your financial reviews to gain a holistic view of a company's stability. This proactive approach can guide smarter investment and business decisions. Are you assessing the financial health of a company? Start measuring their solvency today, and you'll be one step ahead. Stay informed, keep analyzing, and always ask questions. Your financial future depends on it. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.